Nifty. Ajay Bagga is with us, one of the best known market voices and one of the most experienced market voices. Mr. Bagga, let me start off with the Nifty itself. Something that happens is that when the Nifty goes up, you go to the consensus earnings estimate from analysts, that also automatically expands. And somehow the price earnings ratio remain more or less the same. So right now we're seeing a 1 year forward about 850 odd rupees for the Nifty, and at 9,000 Nifty would be at about 15.5 times, currently about 16 odd times. Currently about 14 odd times. Now, give us a sense. Do you think that the Nifty currently is overvalued?
Yeah, morning, Anindya. I think overall, if you see, the entire emerging markets are much more overvalued vis-a-vis historical average price earnings. Within that, India always, trades at a premium to the emerging markets pack. That's been a historical truth. And we are fairly valued. I would say we are in a range of fair value, not overvalued, but definitely not cheap. But India never is cheap. Given the high ROEs that we traditionally have commanded, those have come down in the last 3 years, and the higher growth that our companies have shown, again, that has come down. But the premium is still there to emerging markets, but not as much. But overall emerging markets, I say about 13 times 1 year forward, are running at about 16 times 1 year forward. So we remain a little bit overvalued vis-a-vis the emerging markets as well.
All right, just stay with us. There's a news coming in on Dr. Reddy's, and Dr. Reddy has launched the antacid omeprazole sodium in the US markets. We just show you what's happening to the Dr. Reddy's stock at the moment. You've just got news that the antacid omeprazole, which is one of the most popular drugs right now to treat reflux, acid reflux, something that Americans are very prone to, thanks to the kind of fast food they eat. Back to Ajay Bagga. Keep an eye on the Dr. Reddy's stock. As we mentioned, that omeprazole sodium capsules have been launched. In the US, the market is big there for omeprazole, and it's generally a slow release capsule which is sold. So we'll have to look at what the exact capsule that Dr. Reddy has released at the moment. Ajay, let me ask you about some of the numbers which have come out, and I'll start with TCS and Infosys. If you look at the top line growth, then muted. If you look at the PAT growth, muted. Is the game changing for these companies now?
Yeah, again, because of SEBI reasons, I don't talk on particular stocks, but looking at the sector and looking at the way the bellwethers have given guidance.
I just want to get a sense of the IT space. Has the game changed? A lot of analysts are now saying that the global game is changing. It is moving towards, automation, artificial intelligence, what we see in the likes of Tesla or Amazon, or what Google is doing. And on the other hand, there are these big companies which are doing these things. On the other hand, there are absolutely homegrown companies which are producing apps which are very easy solutions to complicated problems which no longer require people. So the cost arbitrage is going, so that entire Indian ITS sector is now going to get derated. Do you agree with that?
Yeah, I think three things here. One, I would totally agree with you that the drivers are very different, and we are laggards there. If you see Amazon, for example, it has more than $10 billion of revenues on the cloud space. Each of our big IT majors have not more than $1 billion in cloud. And that's true even for, say, an Oracle, which also has been left behind vis-a-vis cloud, where they were making servers, and that has been a game-changing technology with cloud coming in. And they've been left behind while Amazon has grabbed the opportunity. So it's a changing landscape in a very cutting-edge sector. I think our IT majors no longer deserve the valuations they have been getting because they have been slow. Second is we have been waiting and watching that what will they do with the new startup economy, new shared economy, new aggregator economy. There is not much coming. Look at Google, look at even a laggard like Yahoo. The number of startups that they incubate, the number of startups that they are buying every quarter, and our companies are just not there. The third big part is how are they going to use their cash? So if you may, the old tech like the Ciscos or the Microsofts, even the Apples of the world have now moved into an old tech category. They are no longer the emerging companies or unicorns. What they are doing is they're doing a lot of share buybacks and they're paying out a hefty dividend. So people are playing them as a good dividend yield.
The other option is to get into new tech or become start buying out unicorns, right? Use your cash to buy out unicorns and become new tech.
Absolutely. Absolutely. So that was my second point. You're neither doing startups, nor are you buying startups, nor are you starting labs where you allow employees. Look at the Pokemon Go. That was from an employee who made the Google Maps, who's made Google site, Google Earth, and he was incubated along with Nintendo and into Niantic, and now he's got the winner product which is giving them $2 million of revenues per day out of nowhere. Now, we don't have that in any of our big IT companies. You are sitting on 30,000 crores where you are buying Government of India guilds. Why are you doing that? That's a shareholder question. You're bringing down the ROE. You don't return anything to shareholders in giving good dividends, nor you do share buybacks. So why should we give you a premier valuation? You're outdated as far as technology goes. You don't do anything with your cash hoard, nor are you doing any cutting edge work trying to be nimble like a small company. So I would say it's a big derating, and also it's sad for the Indian market because it's 19% of the Indian market, and if this sector does not perform, then our market gets a big hangover based on their non-performance. So we'll see a further derating, I feel, and there's clearly no big driver coming in that either they are doing big data or they're doing analytics, cloud, or Internet of Things in a big way, or incubating startups, or at least use your cash hoard to retire your shares and give a share buyback or give a hefty dividend. You look at the US tech sectors, they have one of the highest dividend yields at 3.5% plus. Even you look at utility companies in the US are running at 1.7% dividend yield, while the old tech, the Microsofts, the Ciscos, are funneling back a lot of the cash to shareholders as dividends. So at least give a bigger dividend than the puny amounts that you are paying despite generating this cash.
All right. Would you say that there are different kinds of bull markets, and right now in the US we are seeing amazingly that when the Dow is hitting an all-time high, it's being led by actually the defensives. It's being led by telecom, which is a defensive in the US. It's being led by utilities. It's led by consumption. Do you think the time has come again that if this bull market has to continue, it's not the high growth space which will do it, but actually the cyclicals, the fact that materials, energy, cement, all these things will actually again pick up the market?
Yeah, absolutely. And if you see last year, we were wondering, and even on your show we had discussed that people like Blaupost, Sid Klarman, even Bridgewater, all the big hedge funds were overloading on energy in the middle of last year, and through this year they gave very poor returns. And now look at the kind of run-up in the materials and energy sector. The smartest money was making moves there, and I think they have been proved right. Clearly, those were really hit badly, those sectors, and they went for value and they made good returns. You look at Howard Marks' portfolio, the kind of money he's been making in a negative yield scenario is really quite amazing. So spot on, I would agree with you. The leadership is changing, Remember, US remains a very big consumption economy. The retail numbers last week were very good year on year, much higher than anticipated. China's retail numbers came at 10% plus. So really looking like the defensives are coming back strongly. The high growth, high beta sectors, right now it's not so much in fashion. Overall, global growth is moving towards a new normal, maybe a sub 2% kind of a global growth. That's what investors are realizing. Third big point is $11 billion came last week into US equity funds. So the retail participation is perking up. This is after 160 billion being withdrawn year to date till about the beginning of July. So that's a big trend reversal. It's a tired bull market, 7.5 years old bull market, second longest in terms of tenure. Only the 90s dot-com bull market was longer than this one. So there have been enough people, starting from George Soros to David Einhorn, calling for an end of this bull market, but seems it's still got some legs and more money coming in. It could be a contrarian indicator in India, as you always say.
Kind of
but
negative yields
not
that you
very
get
sure.
on
Right now, don't fight the flows.
Debt market, everything has to go into equities in the US. Okay, I have one more question, then my colleague Pankaj has a few questions for you. You know, usually right after Narendra Modi came to power, there was a lot of expectation that a lot of investments will take place in the capital investments will take place, infrastructure would take place, and the general advice you got from analysts and brokerages was play through the financials. Now that did not happen, right? However, even now there is a case to play through financials, not because of infrastructure but because of consumption. Would you agree? And therefore play those financials which are into small housing, which are consumer facing.
Spot on. And remember, 20% of the Indian market is financials. Now there's a big segment of PSU banks which have been doing well. There is a division on the market. Some say that it's reached its bottom and stressed assets have peaked and it will be better from here. We feel that there's still 4 to 6 quarters of pain left. There will be surprises, and the kind of numbers government is talking are too small in terms of capitalization. So markets being forward-looking are giving them a better premium from 0.4, 0.5 times price to book. It's moving to 1 time price to book. I think that is overvaluation territory for PSU banks, but who knows? I would say consumer-focused NBFCs and consumer-focused private sector banks, housing finance companies, again, leave out the market leaders. Those are getting hit because it's a market share game. Everybody and his daddy is launching NBFCs with housing finance focus because that's a very good game, and given the leverage that you employ on the capital you put in, you make really outlandish gains. So, and the Indian consumption story along with it. Having said that, I would say yes, private sector banks focused on consumers, NBFCs focused on consumers, housing finance companies. These would be a very sweet spot for years to come in the Indian economy. Not cheap. There are companies which are running at 8 times price to book in the microfinance segment. I would stay away from them. That's very frothy. People are discounting in 60% year-on-year growths for the next 2-3 years. I don't know if you can, once you start getting to scale, if you can grow like that. 20%, a lot of banks are giving you at scale with very good managements. I would say stick to them. You'll be well rewarded. Look at the price to book very closely. That gives you a good indication of where the overvaluation is.
Right. Ajay, let's just stick with the financial space and let's divide it into various parts. So there is PSU, there is private banks, there is NBFC, MFI, as you just said. Let's start with the private banking names. We got IndusInd declaring numbers, decent set of numbers. But, IndusInd has always been different. So do you think when Axis, when ICICI, when they come out with numbers, you will get a better trend of what's happening in the sector? Q1 would be different because in Q3 and Q4, we knew that there is a AQR process because of which, there may be elevated levels of NPA. So do you think Q1 in that sense will become important? If the trend continues without a AQR as well, then it's a matter of concern?
See, again, the trend is very much there in terms of corporate loan slippages, Pankaj. If you see Q4 last year, calendar year, was 45,000 crores of slippages. Q1 calendar year this year was another 55,000 crores. Next 2 quarters, you'll see north of that kind of a number. The cleanup has still not happened. You're talking of 10 lakh crores of impaired assets out of a total 80 lakh crores bank asset book. So that has to get cleaned out slowly. You're cleaning it out at the rate of about 55,000 crores a quarter in terms of recognizing, not in terms of provisioning or write-offs. So because that kind of capital or cash flows are just not there. Capital has to come from outside. So it's more an Italian kind of a scenario where banks have huge NPAs. The government has buried its head in the sand, is not recognizing it. Market keeps on raising straw men and saying, announcement. Whole of last week, PSUs were getting bid up that announcement on capitalization is coming. What are those announcements? 15,000, 25,000 crores. That's just a drop into the 4 lakh crores of new capital that you require to meet Basel III by 2019. So you're just not having that kind of money even on the fiscal book of the government or in terms of being able to privatize these banks. So it's going to be a slow pain where this stop-start kind of a market. Now you can take a 3-year view and buy PSU banks, most welcome. I would say there you will be rewarded. On a 1-year view, I don't know whether there will be accidents and where again you will have sharp cuts. So on a risk reward, I don't think you're being paid well enough to get into PSU banks. You have better options, private sector banks. Again, the corporate private sector banks, you have to look and see how fast are they cleaning up. I think a couple of them did a good job last quarter. We'll look at management guidance this quarter, and then you could see a re-rating coming in the corporate-focused private sector banks. Overall, you're well paid in sticking to the consumer-focused ones because, remember, Indian economy is like the US in terms of the customer spend to GDP number. We are also at about 60% plus. So it's more Japanese, more US than the Chinese model. And that is going to mean a lot of consumption, a lot of expansion in consumption, and which will get financed through these companies. So long as they can keep their credit costs in control and they have a decent NIM and you're not paying too much in terms of a price to book is not really outlandish, then you have a very good risk-reward ratio and you would be well rewarded as an owner of those kind of companies.